Saving money has always been presented as a moral act. It's not just financial advice. It's a character trait. If you save, you are disciplined. If you save, you are responsible. If you save, you are thinking about the future. Parents teach it, schools repeat it, banks promote it. Open a savings account. Prepare for tomorrow. Build security. And for a long time, this advice made sense. But what most people don't realize is that this advice was designed for a different economic environment. Because modern economies are not structured around saving. They are structured around movement. And when the structure changes, but the advice stays the same, the results change too. There was a time when saving alone could build wealth. Interest rates were high. Savings accounts paid meaningful returns. Government bonds yielded enough to outpace economic expansion. You could deposit money and watch it grow in real terms. But over the past decades, something shifted. Interest rates structurally declined. Markets became financialized. Capital markets expanded. Today, a savings account rarely grows meaningfully beyond inflation over long periods, which means saving preserves nominal value, but often fails to preserve relative position within the economy. And that distinction is critical, because wealth is not just about absolute numbers. It's about relative power within a growing system. When you deposit money in a bank, it doesn't sit in a vault. It becomes part of the credit system. Banks lend it. They multiply it through fractional reserve mechanisms. They generate returns by putting it into circulation. Your deposit enables mortgages, business loans, credit lines, investment expansion. In other words, your savings become productive. But here's the asymmetry. The bank captures the majority of that productivity. You receive a fixed, limited return. Your money participates. You don't fully participate with it. That's a structural gap. And over decades, structural gaps compound. Modern economies reward ownership more than storage. If you own equity in businesses, you benefit from profit growth. If you own real estate, you benefit from asset appreciation. If you own productive capital, you benefit from expansion. But if you hold idle cash, your participation in growth is indirect. And indirect participation rarely captures full upside. This isn't about greed, it's about incentives. The system is designed to stimulate activity. Borrowing stimulates activity. Investing stimulates activity. Entrepreneurship stimulates activity. Holding money still does not. So policy, credit conditions, and financial infrastructure tend to favor movement, not stillness. Here's where it becomes a social issue. We teach financial caution, but we don't teach financial positioning. We tell people, don't take risks, but we don't explain that avoiding all exposure in an expanding economy is itself a long-term risk. We praise savers. We rarely teach them how to transition from saver to owner. So millions of disciplined people do everything right and still fall behind asset growth. Not because they failed, but because they followed incomplete advice. Imagine two individuals. Both earn the same income. Both are disciplined. Both avoid reckless spending. One keeps the majority of savings in cash. The other gradually acquires diversified assets. After 20 to 25 years, the difference isn't marginal. It's exponential. Because growth compounds where exposure exists. And compounding doesn't announce itself. It accumulates quietly. Until one day, the gap is impossible to ignore. Saving is not useless, it's essential. Cash provides liquidity, stability, optionality. It protects against emergencies. But protection and growth are not the same function. A shield is not an engine. Confusing the two creates stagnation. Savings protect your present. Ownership builds your future. The issue is not saving money. The issue is stopping there. In a credit-driven, asset-driven economy, wealth concentrates where growth happens, and growth happens in ownership structures. So the real question becomes, are you merely storing value, or are you positioned where value expands? Because in a system designed around expansion, standing still is not neutral. It's slow detachment from the engine of growth. And over decades, slow detachment becomes visible divergence. Don't just preserve, participate.